Hey everybody, in today's video we're going to be talking about annuities. For those of you who are worried that you don't have enough saved up for your retirement, annuities are great products to invest in so that you don't outlive your retirement assets. Hi everybody, I'm Star Tower, your financial fitness coach, here to empower you to become financially healthy and to live the life and retirement that you and your family deserve. Welcome to Wealthy Wednesdays, where I talk about concepts related to building long-term wealth and financial planning. So in today's video, we're going to talk about a financial tool that doesn't always get the attention that it deserves. Annuities. Annuities can be a powerful investment option if you understand how they work. So let's dive right in. First off, what are annuities? Annuities are basically a contract between you and the insurance company, and it's a product designed to protect individuals from outliving their retirement income. So most of you are familiar with life insurance, right? So while a life insurance policy is designed to protect your loved ones and your legacy after your death, an annuity is designed to protect you while you're living so you don't outlive your retirement income. So basically, this is a hedge against you not having enough retirement savings in your 401k, your IRAs, or your other retirement accounts. So how do annuities work? So you either make a lump sum payment. For example, you can transfer your 401k from your old company into an annuity IRA, or you make a series of payments. And in return, the insurance company provides you with a steady stream of income, either immediately or after a certain period of time. There are two distinct time periods involved with an annuity: the accumulation period and the payout period. The accumulation period is the time during which funds are being paid into the annuity. The payout or annuity period refers to the point at which you start getting your benefits. And benefits can be paid out monthly, quarterly, semi-annually, or annually. So annuities can be broken down according to when you would start getting the benefits. So they can be immediate or deferred. So immediate annuities are usually purchased with a lump sum payment, and they start generating income stream within the first year. So if you think of lottery winnings, that is an example of an immediate annuity. Its purpose is basically to provide for the liquidation of a principal sum of money. So immediate annuities may be suitable for those seeking short-term stable income. So deferred annuities will start generating a steady income payment at a future date that's either set by the insurance company or the annuity owner. Deferred annuities are usually funded from either a single lump sum payment or monthly installments of payments. And these are more suitable for investors looking for long-term growth and flexibility in their retirement planning. So there's many kinds of annuities based on their investment types, but we'll cover the most common ones today: fixed annuities, index annuities, variable annuities, and I'll also get into an annuity that has become really popular over the last couple of years: registered index-linked annuity, or RILAs. So with a fixed annuity, the insurance company basically guarantees a predetermined income, which is paid each month for the life of the annuitant. So basically, the recipient or annuitant will receive this fixed monthly income for the remainder of their life. This is the lowest option, which makes it great if you're looking for stability. With an index annuity, that's tied to a stock market index, such as the S&P 500. But you're guaranteed not to lose money if the market goes down. You won't get all the market's gains, but you also won't incur all its losses. Variable annuities, your payments are based on the performance of investment portfolios, such as mutual funds. The benefit here is potentially higher returns, but there's also risk. If the market goes down, so do your returns. I also talked about registered index-linked annuity, which have become really popular over the last couple of years because they share characteristics of both an index annuity and a variable annuity. I'm going to provide a high-level overview of it for now and deep dive into it further in a future video. So RILAs are similar to an index annuity in that they are tied to a stock market index. But the really cool thing about them is that they have a floor or buffer, which protects you against losses if there's a downturn in the stock market, but they also have caps as well, which also cap your gains. So based on the insurance company, they can either set a floor or a buffer on your annuity. So the floor is basically the maximum percentage loss that you're willing to absorb if there's a downturn in the market. So any losses greater than that will be absorbed by the insurance company. So if your floor is 10% and the stock market index underperforms by 20%, you only incur a loss of 10%. 10% is the maximum percentage of loss that you would incur. RILA buffer is the maximum amount of loss that the insurance company or RILA provider will absorb. You only incur losses if the stock market index incurs losses that exceed your buffer. So for example, if you have a 10% buffer and the stock market index incurs a loss of 15%, the insurance company will absorb 10% of that loss, so you would only incur a loss of 5%. So at this point, you're probably thinking, well, that sounds too good to be true. What's in it for the annuity provider? Well, earlier on, I talked about this annuity having a cap, right? So this cap would basically limit your gains if the stock market index overperformed. But basically, if your insurer sets a cap of 10% and the stock market index performs by 20%, you would only see gains of 10%. So that's basically how RILAs work. While you don't incur as much losses if there's a stock market downturn, you also don't generate as much gains if the stock market overperforms. So why should you consider investing in annuities? Let's go over several key reasons. Number one, lifetime income. A big benefit of annuities is that it provides lifetime income. This is a huge advantage for retirees who are worried about outliving their retirement savings. Annuities can provide a guaranteed income stream for the rest of your life, which brings peace of mind knowing that your basic financial needs will be taken care of. Another benefit of annuities is tax-deferred growth. This means that the money that you invest in your annuity grows tax-free until you start receiving payments. This can help your money grow faster due to tax-free compounding for your investments with a guaranteed cash payout in the future. Number three, customization options. Annuities can be tailored to meet your specific needs. You can decide how long you want to receive payments, whether you want a fixed or variable payout, and can even add in benefits like death benefits to your loved ones if something happens to you. Number four, protection from market risks. So as I talked about earlier, fixed, index, and even RILAs offer protection from market downturns because of the way they're structured. They give you the potential to grow your money with the market without worrying about losing everything if the market crashes. Now, before you rush out and invest in annuity, there are a few factors to consider. Annuities aren't for everyone, and they work best when they're part of a balanced financial plan. So here are a few things to keep in mind: your liquidity needs, your long-term commitment, and fees and costs associated with annuities. Regarding liquidity, annuities, especially deferred annuities, usually have a surrender period where you can't easily access your money without incurring penalties. So if you're looking to access your money in the short term, this could be a drawback because annuities are not liquid assets. In terms of long-term commitment, annuities are designed for long-term financial planning, especially for retirement, so you don't outlive your income. If you're not in it for the long haul, this might not be the best option for you. Annuities typically have provisions that penalize investors if they withdraw their investments too early. Also, similar to IRAs, you could incur tax penalties if you withdraw your investments before you reach a minimum age of 59.5 years old. However, most annuities do allow investors to withdraw without penalty for qualified purposes, such as if you have to be in a hospital or nursing home for 90 days. And some annuity contracts also have provisions where you're allowed to withdraw 10 to 15% of your investment per year without penalty after a certain accumulation period. And regarding fees and costs, annuities have gotten a bad rap in the past for high fees and costs associated with them compared to other investment options. So you'll carefully want to review various annuities and their costs associated with them before making a decision. So these are the things to consider before you decide to invest in an annuity. So there you have it. Annuities can be a great option for those who are looking for stable, long-term income, tax advantages. But like any financial investment, they're not a one-size-fits-all. So make sure you consult with a financial advisor to see if annuities align with your overall retirement strategy. So thank you for watching my video, and if you found this video helpful, please give it a thumbs up. I'll be deep diving into RILAs in a future video, so make sure you subscribe to my channel so you don't miss out on that content, as well as future content on financial fitness. And please share this video with someone who's working on their financial fitness. Let me know in the comments if you have questions on annuities or other investment topics. Or contact me if you want further advice on retirement investments. Until then, looking forward to continuing our financial fitness journey together, and see you in my next video. Bye guys.